Hi, everyone. It's John. It's Thursday, March 30th, 2023. I'm recording this Thursday night after the close. I think we're at a pretty interesting juncture, and I wanted to share some thoughts of what I'm seeing in the market. So again, this presentation is by Rain King LLC. And as you know, I'm an amateur individual growth stock investor, not affiliated with MarketSmith or IBD. So the agenda is to quickly go over the context, some market internals, a topic called Mkt Catalyst or market bomb, watchlist ideas, and a summary. So on the context, this is the S&P 500. This is a weekly chart. And just quickly showing the bear market downtrend and how we broke that downtrend on a weekly basis. And then we had the banking crisis. We came back down to the vicinity of the December lows, but we are holding above the 10-week moving average and the 40-week moving average as well. You'll notice that the relative strength line, and this is comparing the S&P in this case to the NASDAQ, shows that the S&P has been underperforming versus the NASDAQ, and we've seen that in growth stocks since the beginning of the year. This was my comparison of the 1962 bottom to 2023. I won't go over the details because I did in the last video. The point was showing that a market retest and a test of the lows occurred in the Cuban Missile Crisis, very similar to maybe it's possible that the current banking crisis is the last shake in this downtrend, this bear market. We came down and retested the lows. We'll have to see if this crisis can be resolved to the upside. We talked last time about kind of a digestion period for February and March historically after a really strong January. And we're optimistic that maybe these trends can continue to have a good year. So let's get into the market internals, some of the things I'm seeing specifically. So this is the S&P 500 at the top with volume, and at the bottom it's showing new highs and new lows. So interestingly enough, the S&P, if you look at the fourth quarter of last year, the S&P actually had a gain from where it started to where it ended. It actually had a 7% gain. Now in the first quarter, which we're just about there, tomorrow will be the final day of the quarter, the current gain is another 5%. So amidst all the volatility and the sloshing around, we actually held the December lows during the banking crisis. And the market, believe it or not, has actually ground its way higher. And we just mentioned how it's held some key moving averages and gotten back above the 50-day. Now, new highs are in these green bars versus new lows, which are red. You can see that there's been a little bit of improvement as we started to come up here and try to rally. So some improvement here on the New York Stock Exchange. Now, interestingly enough, Carson Research did a study where they have a table here which shows when the S&P closes Q1 and it holds above its December low, good things typically happen. And they show from 1950, and I had to break the table up. This goes up into 1987 through 2023. But when that condition occurs, look at the gains. They're very positive. They're all green, except for a couple of years. 2011 was a red year, and 2015 were tough years. And recently, the last 3 years, we were over 19%. So if this were to hold true, we held December lows. If we do that tomorrow to close the quarter, that could bode well. Now, this is the NASDAQ. And again, looking at new highs and new lows, we had a follow-through day on yesterday. It was a fairly weak follow-through day, 1.7%, but it was below average. The volume was not there. Stocks that broke out were mixed. Not many had big volume. But I wanted to just talk about the new highs and new lows. You can see that the new lows are slowly starting to dry up a bit, which is good. But the new highs is really stagnant. It's kind of just going sideways. So we're getting net new readings that are positive only because the new lows are shrinking. We'd much rather see a situation here in a good, healthy rally where you can see the new highs are significantly high and trending up more than this. Now, hopefully this right here, if we get a rally, could morph into this situation and maybe we get a move. So the NASDAQ has some work to do on the internals, but we'll see how it plays out. We had a gap up yesterday, another gap today. Now, looking at a couple of ETFs, you'll notice on the left, this is the PSJ. This is actually the software index, and I divided it by the S&P 500. And you can see that since the beginning of the year, believe it or not, software, computer software enterprise, which was one of the leading groups for a number of years, is starting to exert itself. I've noticed that in the last couple of weeks, it's really been strong as it's coming up the right side. So that's something to keep noticing. I've noticed that some of my names in my watch list all of a sudden are computer software. Semiconductors, probably no secret here that since the start of the year in 2023, you can see the uptrend that the SOX index has been in relative to being divided by the SPY. Strong performance by semis has been happening, and there's a lot of names in that group that are extended, but they're still showing strength and they're getting some volume. So market catalyst or market bomb. On the left, this is a chart that I showed at the end of December, and it's just kind of a composite of a number of different indexes and the consumer price index, unemployment growth. But the one that I focused on in December was this one, the personal consumption index, which is a broader measure of inflation. And it's one that the Fed concentrates on. And the goal is to get this down to the 2.5% level is what the Fed has targeted. Historically, it's been in 1.7 range. And you'll notice that it had been stubbornly up around 5.5 to 5 throughout 2022. So if we look over here on the right, this turquoise line is the PCE relative to the index of the S&P. And you can see we've came down to 5, we inched back up. But since the beginning of 2023, things have got coming down a little bit, and we're at 4.3%. So we're still not near the target of where we want to be. The Fed wants to gradually get this down to 2.5%. But we have the PCE report tomorrow, and that's one of the reasons I'm recording this video tonight. Now, this is a National Bureau of Economic Research. This is showing jobs. And what's important about this is job growth. And I showed this chart in December, and the gray zones are recessions. And the point of this chart was to show that job growth typically will slow to less than 100,000 jobs per month, about 6 months before an official recession starts. And you'll see it here, it happened here, about 6 months of weak job growth. Now, we in 2021 and 22 we had a very strong job growth, over 500,000 on average. More recently, and even I think in February, we still had roughly 300,000 job growth. So the Fed really wants to see this come down at least to the 200,000 range. Getting below 100,000, though, would be an indication that the economy is really falling out of favor and maybe a recession is coming. So there's still work the Fed needs to do to deal with this in combination. They're looking at the PCE. So I wanted to go over some watch list ideas because I think the PCE tomorrow could be a real catalyst for the market if they get it shows a decline. If it stays stubbornly high, that could be a headwind. So there are some real names that I think are showing great action. They are starting to shape up in their bases. Some of them are showing breaking out of bases. Some of them are really acting more constructively. So here's On Holdings. I will disclose that I have a position in this stock. This is its high volume close. It's been holding the orange line, the 5-day exponential moving average. And for those of you that have gone to the workshop on gap ups, we've showed the importance of how you can use this combination of tools. HubSpot, I think has moved up nicely, gotten some good volume, had a breakout of a shorter term base, but then it had this consolidation. In the consolidation, there was a nice shakeout, and the stock has really started to respect all the moving average here that were clustered together. We have a nice downtrend line, and the stock is moving. It seems to be wanting to move out of this entire base structure. So that's good. PagerDuty, another stock that had a gap up, and I've drawn this line kind of a gap day high. And in combination with the 5 exponential moving average, we've talked about techniques we can use in the Gap Workshop about how we can enter stocks using these tools. But I think this chart also is showing some promise. Now, also, here's 3 more. This is Samsara, which is IoT, which I disclosed that I also have a position in this stock. Nice little downtrend line after a gap up, some really good quarterly numbers, good outlook. Stock moved out above the downtrend line today. Mkt is a stock that gapped out a couple of weeks ago, and it's been acting really well, and it's kind of coiled up into a downtrend line, and the bottoms have formed this kind of tight coiling action. And today we saw the stock actually try to move out, but it kind of came back a bit. But I think the action is very constructive. And then New Relic, which looked very promising with a very strong power earnings gap, looked really great, but it has drifted lower. And it's drifted all the way back down to the 50-day moving average. But now it has a downtrend line that we can use to potentially find an early entry. It's still got some resistance and things to get through, but stock has really good fundamentals and good outlook. Now, none of these 6 stocks are stocks that I'm recommending for purchase. You need to evaluate them yourself. I'm just showing things that are certainly on my watch list. I think things look interesting. There's a lot of others that I did not make slides of. There's probably at least 5 to 10 others that look good. But I wanted to just put a few in front of you because I think we need to be prepared that if we get a good PCE number, we could have things start to move. So in summary, we've talked about this last week. With all the bad news, the markets have not fallen apart. They've actually held the December lows, and they're trying to move higher. Now, the news is awful. A lot of people are bearish and almost given up on the markets. People are very bearish. Bottom line, though, is there's still no strong trend, so we're still waiting to see if we can get one established. But there's plenty of evidence of bearish positioning. Sentiments like the American Institute of Individual Investors is extremely bearish. We've heard over the past few weeks that individual investors are scared. They're moving money into money markets at a record pace. So people are very, very nervous about the markets. And sometimes when you get everybody on one side of the boat, things can change if there's a catalyst. So Wednesday's follow-through day, I would say, was not very strong, but we certainly want to be ready. If you didn't make a purchase of something, you want to be in tune to be ready to if we get some follow-through. The follow-through day had below average volume. We didn't see stocks that really broke out with a lot of conviction, maybe a couple. And I mentioned to you, we looked at the chart, some of the internals are still fairly, they're still mixed. So it's not giving us a real all clear yet. Now, the catalyst or bomb is this PCE tomorrow, Friday at 8:30 a.m. Eastern time. Fed really has their eye on this. They kind of use this more than the CPI number. So if it shows inflation is declining, we could get a sharp rally in stocks. So that would be positive. That's why we want to be prepared with our names and ready to go if things look, we get a good reaction. Now, if the PCE is an unfavorable number, it certainly will be a headwind to establishing some sort of trend, and we'll have to see what the reaction is. It's always about the reaction. Even if the PCE number is unfavorable, but if we get a really good reaction, it will basically be telling us the market is looking past that 6 to 9 months. As I mentioned, growth stock names are really building better bases. They're much more constructive than we've seen in a while. So you got to have your watch list ready in case things start to move. So the quote of this week is, "Good luck comes to those that are prepared." And that's one of the reasons for the video tonight. I wanted to bring some things to your attention so you can prepare for positive and negative scenarios. Now, before we leave, I wanted to just remind people that the Earnings Reaction Gap Workshop, we held our executive VIP session last Sunday. It was a tremendous 6-hour marathon, tremendous feedback. Thank everybody for joining. But we are having another one of these on Saturday, April 15th. The workshop's different because it's a different level of participation, but it includes over 4 hours of pre-recorded videos and 4 hours of live instruction at the workshop. I hate to be shilling things because I normally don't sell a lot of things, but I do think this is a really good quality workshop and material with buy strategies that a lot of people could benefit from. So if you're interested, go to this website and watch my YouTube video. It's 7 minutes long. It'll give you all the details and how you can participate. So I'll leave that at that, and we'll wrap up. This is March 30th, 2023, and this is the general market update. We'll see you at the next one.